Erin, Rob, it's such a pleasure to meet you. I love industrial real estate. It's so interesting to learn more about this topic. First of all, please introduce yourselves, name, position, company name, position, and then we'll roll into talking about the background of your company.
Sure. Hi, I'm Rob Boese. I'm the CEO of Warehouse Partners out of Fresno, California. We specialize in multi-tenant industrial.
I'm Erin Volpp. I'm the COO of Warehouse Partners.
And you are in Fresno. So off the record, we'll talk about that afterwards.
Sure.
The whole thing I've got going with Fresno. All right. So first of all, tell me about the story of your company. I had a look at your LinkedIn profiles a moment ago. Tell me about the background and story of your company. Where do you come from?
Sure. I'm a New Yorker, and the question I always get is, how did you end up in Fresno, California from New York? And really, the story behind Warehouse Partners is a really long traveled road to multi-tenant industrial. Right? How does a New Yorker get involved in multi-tenant industrial in California? My family was involved in medical office, multi-tenant medical office and lab space. My dad was a surgeon and my mother was all action property manager. And that was my first job as a young kid, as long as I can remember. And that's really the genesis of my commercial real estate career is, frontline management, leasing, dealing with practice managers as a young person, which for most young people is a terrible job, right? And dealing with practice managers and surgeons and things like that. And, but a wonderful education and a great background, and something I appreciate now, but couldn't visualize as a kid, right? You always want to do something else. And when I went away to college, I went to Johns Hopkins and came back, my parents weren't doing too well health-wise, and I took over the business. And so that was my job to lead a disposition on that portfolio, moved to New York City, met my now wife, and the recession hit. And so in 2009, she said, nothing is happening, Rob. I'm moving back to Fresno. Would you like to join me? And as we like to say, I didn't really know anything about California. I didn't know anything about Fresno, like a lot of New Yorkers, right? We live in our bubble. And so when I moved out here, I thought I was moving to Hollywood. I thought I was moving to the beach. But here I am in an agricultural, industrial area in the middle of California. And for those who don't know, I am how many hundreds of miles? 150?
Yeah, at least.
Plus miles away from
the 2-hour drive.
2-hour drives from the nearest beach, right? And so I really didn't know what I was getting myself into. And so, I searched and tried to get a job, and nobody knew what to do with me. I had all this commercial real estate, property management, sales, leasing, all action. And so I was eventually lucky enough to get a job at a property management company, asset management company. And one day on my desk appears dozens of banker boxes, right? And I said, hey guys, what's going on? And they said, hey, Rob, congratulations. You are going to be the light industrial practice manager here at the company. What do you know about light industrial? Nothing. I'm from New York, right? We don't have room for sprawling industrial sites like this. And they said, do you want to do it? And it wasn't really an option, right? They weren't really asking me. And so opening those boxes and uncovering what had appeared on my desk it was a portfolio from a family office, and they had a portfolio of 34 industrial multi-tenant light industrial buildings, and they were in various different shapes. And in those banker boxes, built in the 60s, 70s, some in the 80s, and they had these legacy tenants. It was in the middle of the recession. They were about 60% occupied. And so
which recession? 2008?
Yeah, this is 2009, 10, 11, what's going to happen next in the world. And so there was a lot of transition as people who know industrial that's really where industrial started really kicking off. There were some deals to be made. There was a lot of decisions to be made about tenants and what would happen going forward. E-commerce was just an idea, right? It was just coming to fruition and ordering things on the internet. So it was an interesting time, and uncovering all of the mysteries that this family office had of 264 tenant spaces or something like that. Long story short, they turned around 12 months later and decided not to renew that contract because They had developed it. They had, managed it. They had put in the tenants. They did the accounting in pencil for 20, 30, 40 years.
Right.
And so they weren't used to a 60-page accounting report. So
They didn't like Yardie.
they didn't like software. And so they turned around and let my company know that they weren't going to renew. My company turned around, let our section go that was responsible for that industrial portfolio. And then shortly thereafter, the family office came to me and said, "Hey, Rob, we really like you. And for some reason, you really like multi-tenant industrial." And I said, "Yes, I do." And we joke about it now, but one of the things I really liked about it was the simplicity behind it. Management and the leasing and all of those things are complicated in their own way, but at its core, it's a very simple asset. It's a metal shack for the most part on a concrete slab with a parking lot. And how you perform that program is really how clever you are and how thoughtful you are in putting together a program that works on a leasing, asset management, property management level, and it all has to work together. And so I was discussing this with them, and they said, "That's great. You cannot work within the family office because you're not part of the family. You will need to start your own company." I said, "Okay, sure." Because when I worked for my family, I always thought I worked for myself. And so that's what I did. And so since 2013, Boese Property Management and then Boese Commercial has been concerned primarily with multi-tenant metal industrial and the tenants and the sale and leasing and everything that goes with it. And so we were really an all-action firm. We did everything, and we were really thoughtful on, how property should be, addressed from ground level to top level accounting, everything that goes into it. So I'm a California commercial real estate broker. Like I said, I've had that company since 2013. And since then, we really thought about, and we were sort of at the end of that program with the family office, and we were really thoughtful about it. And we thought, hey, they took some of our recommendations, right? We made them.
We increased the value of their portfolio by 70% from the time Rob took it over in 2013 until we exited the family office portfolio in 2016.
And so one of the things that we thought about was, they took some of our recommendations. They made so much money in sort of adapting some of the changes. And most of it was understanding the tenants, understanding the leasing, understanding like how everything works together. And we said, if this was not done in a family office context, right? So you have, family members that are, on the spreadsheet as an asset manager.
The uncle's the maintenance guy.
That you can't fire, right? And you have tenants you can't get rid of, and the tenants not on leases and not performing in the way that they should in a professional commercial real estate context. And we thought, hey, if we ever have the opportunity to do one of these projects ourselves and do it in a professional commercial real estate context, what a project that would be. What would those cash flows be? And the thing that always attracted me to that asset class was when I learned about it, I saw the cash flows. Even though they had put all of these encumbrances on on their projects with all of these challenges, it's still cash flowed.
They still threw off cash like crazy.
And even if they were slow in leasing or they didn't make good decisions on tenants, the demand was still there. And we noticed that demand was there and it was rising and rising, and it was difficult to keep up with. And so all of those things together, we decided, hey, if we have the opportunity to do this, let's see what's available to purchase. And if we can do that, maybe let's invite some investors along for that ride and we'll all share in the profit. And so we really went out and took a look at, okay, let's do a value add. Let's buy one and add some value, paint, patch, re-tenant it, increase the value. And that would have been a very straightforward commercial real estate play. And the thing that we found out was almost immediately is nothing recent has been built. Most of it was older and has lots of challenges. And the number one thing we found out is people didn't want to sell to us.
Or anybody, not just us.
And the reason behind that was the cash flows were good. The tenant demand was there. They didn't have to seemingly put a lot of effort. And it's a project that you could, if you wanted to. A lot of the listeners here may think, okay, multi-tenant metal industrial. I've seen one by the freeway with the roll-up doors and the man door, like the chain link fence yard area.
Trucks everywhere.
Beat up with weeds on it. And that's really the story of a lot of the operators and owners, developers of this asset. They built it 30, 40 years ago. They put very little money, but the tenants still want it and there's nothing else for them to lease. And so seemingly they can let those properties slide. And that's what we found out, is that even though they weren't taking care of them, because of the tenant demand and because of the lack of recent development, tenants would still flock to them and they would have a wait list.
Since the 70s, the amount of development has gone down significantly from like 4 million square feet, I think in the 70s was developed. And in the 2010s, there was 600,000 square feet developed in California.
Yeah,
That's incredible. Of industrial, multi-tenant light industrial.
Light industrial.
So I'll tell you what, but let's back up a little bit. Define, and let's do these briefly because I've got like a million questions to ask you. So give me the
Sure.
Cliff's Notes. I hope that's the American one. I know there's others as well. But anyway, you know what I'm talking about. What is multi-tenant light industrial? Give me kind of the high-level definition. What is that exactly?
Erin, do you want to field that one?
Sure. So multi-tenant light industrial is what its name is. It's a long, or depending on your shape of the building, but our process is a long metal building with multiple tenants in it. And you can kind of liken it to multifamily, the commercial version of multifamily. So you have these small tenants, inline spaces. They have a roll-up door, an office, sometimes a bathroom, sometimes not. That's why ours is good, because we have the bathroom inside. But they are 1-year leases, 2-year leases. The turnover is fast. They're small businesses. A lot of commercial.
How big are the units?
2,000 square feet typically, but multi-tenant industrial can be anywhere from 900 square feet to, I don't know, 25,000 square feet, depending on your unit size. We focus in the 2,000 square foot range. 2,000.
And you said turnover is fast. Explain that to me, because it seems like somebody would move in and then stay.
And sometimes they do. The thing with industrial tenants is that they have varying lifespans of how long they need warehouse for. Sometimes with a growing business, you start in a 2,000 square foot unit and then you need more space, so you move out quickly. Or maybe it's a recession time and you have 5,000 or 10,000 square feet and you move down to 2,000 square foot units. Or same thing in a recession time, you have an office tenant that no longer needs their office space but has to do something with all that furniture. So the tenant flexibility is a really big key factor in the profile of these type of tenants, because they need to be able to move out quickly, which is good for us and good for owners of this asset class, because it means that there's always demand and the turnover is fast and cheap. That's the one thing that's not like multifamily. The turnover does not cost you an arm and a leg. It costs you maybe $100 to get the place cleaned out.
Just a quick note on turnover. Like multifamily, a turnover is an occasion for an increase in rent, an increase in the tenant profile. Maybe you're upgrading the type of tenant. Maybe you're upgrading, just the type of business and how they mix it in a project. And so when we talk about turnover, there's two things. One is we look forward to turnover because of the tenant velocity. And when we talk about velocity, we're talking about demand, right? There's a demand, like any project with a waiting list, right? You can cherry pick the best out of that wait list in terms of maybe it's a lease increase, right? Maybe it's an increase in it's
a cleaner tenant,
corporate tenant, or whatever the case may be. We kind of look forward to that turnover. And then the other half of it is, because they're on relatively short leases, the misconception is that there's a lot of work on the project, right? It's a highly unstabilized project, but that's not the case. It's a very stable asset if managed correctly. And one of the things that goes into it is you get a good tenant on a stable in a stable environment, and they're inclined to stay, even though their lease is maybe 24 months on average. In the past, we've managed significant projects with 12-month leases, and you can imagine how much work goes into the renewals. Between Erin and myself, we've probably signed about 1,000 leases or renewals in the last 7 years, something like that. And we still get calls for people looking for 2,000 square foot plus or minus industrial space, and we haven't had anything to lease in the last couple of years. And
Really?
that's really the story is, we had to hire somebody just to answer the phone or just to return the voicemails from the weekend for the amount of calls and demand we have for that type of space. And so really that's where we see that the deal is, if there's that much demand and there's that many existing tenants in the marketplace with no satisfaction, there has to be a deal there somewhere. And that's really where the genesis of our idea started.
What is your ideal or typical tenant profile?
Yeah, that's a great question. Erin, do you want to talk about tenant profile?
Sure. So the tenant profile is kind of threefold. You have your small established businesses, people who maybe have established a business in their garage and now they need to move up in the world and into a nice professional space. You're going to have a lot of service industry type vendors, like HVAC and contractors and such like that. Then you're going to have your regional businesses that need a migrant footprint along the California border. And then you're going to have a couple of corporate tenants, national firms that need a presence in the Central Valley. So it's kind of a variety, but it's going to be your strict industrial commercial use.
Now, you haven't used the term yet, but I'm going to ask you, what do you invest in? And I'm guessing ground up, but correct me if I'm wrong.
That's correct. And it's going to be ground up because that's where the opportunity is, because nothing recent has been built. And you want us to talk specifically about ground up, Erin, and why we chose Madera of all places in the world.
So let's talk about Madera separately as the deal pitch. I'm now more interested in understanding more about your company and your thinking, kind of general income.
Sure,
We'll dive into Madera deep in a minute.
Okay. Yeah, very good.
So as far as, sorry, I lost my train of thought.
So why ground up? I mean, you're looking to, I mean, you've kind of answered the question already.
No,
but, tell me more about that.
There is no inventory. And so since there is no inventory on the market, most of the deals are off market, or they're because of some extenuating circumstances where the owner of the property has to get rid of it. They, death in the family, transitional, generational progress, or they just have found a better deal. But that is a rarity. When on the market, you get 6 caps, 4 caps, especially in California. If you're looking in the LA region, you're happy with a 3 cap, and that's going to make you satisfied for the next however many years you want to stay in that. But industrial property, there's nothing you can replace it with because the cash flows are so good. So we've done ground up, and the key to that is finding good land, which in California is a hard thing to do. But but
you are surrounded by good land in Fresno.
Yeah,
that is the one.
I'm just making a joke.
That we have land in an abundance.
Yes.
Whether or not people want to sell it is a completely different story. It's kind of challenging itself. Mm-hmm. But Adam, really, the key to our the thesis behind Warehouse Partners is, we did come out of that sort of knowledge and research and diligence. Can we buy something, fix it up? That's the easiest thing to finance, right? From a commercial real estate finance and banking perspective, banks love that. You have perhaps a cash flowing asset already, and they're happy for you to add the value and then maybe have a disposition program. Right. And development obviously has a different risk profile. It has a different, timeline and things like that. And one of the reasons we chose development is the simplicity of multi-tenant metal buildings. And it is, without oversimplifying it, it's basically a kit on a concrete slab with a parking lot and a fence around it. And, obviously we think about the project deeply and it's based on our experience. But if you really back up, if you compare it to other asset classes like retail, multifamily, which has a slew of legislative considerations, neighbors that may or may not want the project. You may think of an office tower and all of the thought and diligence you have to do with the municipality to make that work. Our development thesis is light industrial project on light industrial land in a light industrial area with a municipality, whichever it may be, this project or a future project that wants the project and needs the project and has a tenant demand. And we take all those things into consideration together in our due diligence.
And are you focused geography? You're just Fresno, are you primarily?
So we're currently based in Fresno. We have an investment office in Los Angeles. We don't travel there very recently. It hasn't been necessary. And because of the recent environment, we haven't.
Zoom is the world. So
yeah, we're currently in a virtual world, digital world right now.
Yes.
And
long may it live on, as far as I'm concerned. I love it.
So for us, us doing our projects, let's say in our backyard, is a logical place for us to start. We know the market so well. We know the tenants. We know the land. We know the municipalities that need or don't need it, and the municipalities that may be more challenging to work with. And a lot of it that goes into our project is, based on our experience. We're not just investors that, let's go do this investment and provide a return and we'll make a buck. The Warehouse Partners is really deeply rooted in our experience in multi-tenant light industrial, and people all over the country call us for advice on multi-tenant light industrial. And what do I have? Can I convert the leases? What are the tenant profiles? Can change it to this type of project? Is it possible? What do they trade for? What is the demand? I don't like it. Can you buy it? That type of thing. And here's the price. And so it's interesting. A lot of the stuff that does trade, it's off market, right? People call somebody like me and, what is it that I have? And at the end of the day, Erin alluded to it, they usually end up keeping it. And it's just based on cash flow. If you look at it physically, it's not that exciting, right? It's not something you would talk about in a cocktail party setting. I own an industrial property, somewhere in the middle of California, and these are the tenants, these small tenants and things like that. It's not something that you can really bandy about in that type of setting.
All right, so let's talk about investors and the investor position, right? So you're raising capital to do more of these deals.
Yes.
So what are you raising? You're raising equity, you're raising debt, mezz. What are you First of all, let's start with that. What kind of money are you raising? Capital?
Sure. Yeah, we're raising equity right now, and we're right in the middle of our raise. Aaron, do you want to talk about how the raise is going and sort of the
again? Let's talk about Madeira in a second. Kind of high level. So you're raising equity.
Yep.
What's your minimum investment, kind of at the moment, and bigger picture for future deals as well?
Yeah. So we're raising equity. Our key is having that between 60 to 85% loan to cost for the development. We found that bank financing is really interested in this type of development, which is surprising to everybody, but they have been providing the best rates and the best terms. And so we are doing $100,000 minimum equity investment across the board right now.
And so you can get up to 85% debt loan to cost. What is that loan to projected value?
What is the loan projected value?
No, so your loan to cost, you can get all the way up to 85%, but presumably your lender assumes that there's going to be a takeout after you build. Yeah. So what is that loan amount to projected value of the building?
I'd have to do some math for you on that one. I'm not sure off the top of my head.
So all in, it's about a $17 million project, Adam, and then we're a projected exit at 22 million plus, right?
Right, yeah. 22, and you're borrowing. Okay, we'll get into Madeira, but I'm only interested because it's typically with multifamily. You want you look at the banks look at loan to cost and what the value is going to be when they exit, so that they know that you're going to be able to take them out.
Yes. Sorry, I don't have the percentage off the top of my head.
No problem.
One of the nice things that we found is that banks are really traditional commercial real estate banks, and this surprised us the most, is the private money lenders were a little bit more hesitant than traditional banks. And usually it's quite the opposite. And traditional banks were very happy to underwrite our deal. And that is because banks with a local presence understood the industrial demand, and they were happy to underwrite the deal.
And they've got clients who need it.
Yeah, they understand the small business environment, and that's great. And that's a relationship that we've built with a number of different. They're not even local banks. They're regional.
Regional statewide banks that have a local branch.
Yeah, as long as they understand the local market, it's been extremely interesting. And that's not to say that we couldn't go out and get private debt, but debt is so cheap on the commercial banking side right now that why wouldn't you go with bank debt if it was available to you?
And what is the projected hold time for your investments, but also the amount of time that investors will be in the deals?
So we have a projected 30-month average hold time. And so that includes about 11 to 14 months of actual construction time and about 15 months of lease up.
Which is all generally conservative.
Say again. Sorry, Rob.
That's a very conservative estimate. And so when we talk about estimates and returns and timelines, we're very conservative in our underwriting of those, and especially our timeline. We want to be, let's say, under promise and over guarantee is our objective. And so we're going to stay on the conservative side.
And you are living in a world where people hold on to industrial real estate forever, but you're planning on selling in 30 months. Why?
Yeah, it's interesting. We wanted to complete the project. We wanted to have it built. We wanted to have a good leasing program, enough time to stabilize the asset with good tenants. We're not rushing to lease. We want to lease in a thoughtful way, right, to the best tenants in the market for the best price, of course. Have a stabilized asset, and then we'll have a multitude of different options because we know that the sales market so well, and the people who are looking and hunting for these type of properties that rarely come available. So we'll have a list of potential buyers of people who are looking for this, and that's a multitude: private buyers, family offices, funds, right? Larger commercial real estate firms, and some are publicly traded, that type of thing. And the other strategy for us, Adam, is that we could refinance the property, we could recap it, and then own it in some other vehicle, and then take out all the investors, as they say, get them paid a good return, and have the loan paid, and then take out a permanent loan, and then off we go.
And then get those investors on board for the next development.
Yeah, and I think there's an option for some of the investors. We've had a lot of feedback that they want to stay in the deal. And so that's something that we're currently thinking about is, they don't want to leave after 30 months. They don't want to have to go find another deal. Mm-hmm. And so, like, as Erin mentioned, we'll have another deal that's going to follow up shortly. This is phase 1 of 2. So they can either get on phase 2 or a different deal that we have coming up, or they could possibly stay in the investment for long-term cash flow, really a steady Eddie play at that point.
Perfect. So let's move to Madeira in about 2 questions.
Okay.
Because I really do want to hear about that.
You can tell we're excited about Madeira.
I'm dying to hear about it. This part of the podcast is evergreen. So we'll keep this up on the website forever, and then we'll keep adding your new deals as they come up. All right. So that's why I want to stay focused on you guys, which is why, as you know, people invest in people. So I've got 2 final questions. The second one is double barreled, but the first one is like this. What has been the hardest lesson you have learned in real estate?
Well, the hardest lesson that I've learned in real estate, I think this is a 2-part question. And one of the things that I've learned the hard way is that people are very risk adverse. And that's challenging in a way that even though an opportunity may present itself that's, let's say, unlimited, right, in this example, but because of people's fear and risk reward is always how I think our environment works. There's a certain reward for the amount of risk you put in. But I think people's psychological perception of unlimited risk or the fear of losing sometimes outweighs the deal in front of them. And it creates maybe an unreasonable environment psychologically to do deals. And so you may have, the best investor or the best deal or the best price for, let's say, land, right? We deal with this all the time. And they're worried that somebody might build something and make $1 off of it 15 years from now and hear about it. And psychologically, they can't handle that, and they won't sell you the land because of that. And they can't unravel that. And that's something that, despite conversations, negotiations, if that's the case, and if you finally get down to it, it's very hard to discover and you realize there's no deal here, and it can never be a deal. And something that we can revisit in the future, things might change, but that psychological barrier is something that's interesting that's I have to learn about over the course of my career. And it's also how people guide their investment, thesis. So I have to be cognizant of that too. And so I'm always interested in risk versus reward and how balanced they are mentally and in their portfolio in terms of risk and reward.
All right, Erin, let me ask you this. What keeps you, last question, double barreled.
All right.
What keeps you up at night and what gets you up in the morning? And I'm not talking about your husband snoring.
I was going to say my dog.
Or your dog panting or whatever he does.
No, I think it's anticipation on both ends. It's wanting to make sure that our next step for whatever development we're on is moving forward, and then being excited to get started and get going on it. Like, for example, like submitting things to the city for approval or waiting for those dollars to come in. It's like, oh, I can't think, I want them to come in. I want this to happen. And in the back of your mind, you know, it's going to happen. It's just, I don't have patience to save my life. So that's what keeps me up at night.
Erin Volpp, Rob Boese, Warehouse Partners, thank you so much for doing the sponsor profile on the Deal Time podcast. We will now talk about Madeira, but thanks for being on the show today.
Thank you.
You.
We appreciate it.